Every bull market tells investors the same comforting lie, that this time the rise is deserved, stable, and permanent. Every headline, every glossy report, every optimistic forecast rests on that belief. And every single time, when you zoom out far enough, you see the same brutal pattern. The crash comes, the majority lose almost everything they thought was safe, and a small minority walk away richer than they were before the disaster began. Markets do not just crash. They transfer. Wealth moves from the late, the leveraged, and the hopeful to the prepared, the liquid, and the patient. That transfer is not random. It follows recognizable structures, the same emotional swings, the same policy mistakes, the same replay of fear and greed in one cycle after another. From the South Sea bubble to 1929, from the dot-com bust to 2008 and beyond, the story is different on the surface and identical underneath. This story is about those structures. Not trading tricks, not lottery tickets, but the 15 crash profit patterns that decide who bleeds and who quietly accumulates power whenever the music stops. These are not theories. They are recurring behaviors that appear whenever asset prices detach from reality and then slam back down. If you understand them, you stop seeing crashes as unpredictable accidents and start seeing them as the final act of a script that was written years before. Stay through Fact 7. Because once you understand how early the winners position themselves, you will never look at a booming market the same way again. And by the end, you will see the one step ordinary people can take to avoid being the fuel that feeds someone else's profit when the next downturn hits. Hidden. Fact 1. The winner's position before euphoria. Not during panic in popular imagination. The people who profit from crashes are the ones who buy the bottom or short the top with perfect timing. Reality is calmer and far less glamorous. The investors and institutions that emerge stronger from crises usually make their crucial decisions long before the headlines turn red dot. They reduce leverage, while everyone else is adding it. They quietly trim positions that have run too far too fast. They build cash or liquid reserves when it feels unnecessary. They structure their obligations so they do not have to sell into weakness. By the time the crowd realizes that something is wrong, the most disciplined players have already positioned themselves to be potential buyers rather than forced sellers. The pattern is simple but ruthless. The crash is just the moment when preparation is revealed. Profit is not created at the bottom. It is enabled in the years when everyone else believes there will never be another bottom. Again, hidden fact 2. Every boom contains its own crash baked into the math. Historical crashes look obvious in hindsight. Charts peak, valuations go insane, leverage explodes. While you are living through them, they feel like normal progress. New technology, new policies, new sources of growth seem to justify higher and higher prices. Critics are mocked as pessimists who don't get it. Underneath the stories, the numbers quietly turn toxic. Debt grows faster than cash flows can realistically support. Asset prices rise far above what underlying incomes or profits justify. Households, corporations, and governments lean on the assumption that refinancing will always be possible, that liquidity will always be available. Once enough of the system depends on that assumption, the crash is not a possibility. It is a delayed necessity. Any shock, a policy change, a failed fund, a geopolitical event, can trigger it. The details differ, but the pattern is the same. The seeds of the downturn are planted in the years of uncritical optimism. Those who profit in the crash are not surprised when it arrives. They have been watching the math, not the slogans. Hidden fact 3. Liquidity, not brilliance. Is the real superpower in a crash when markets are going up? Everyone wants to talk about strategy, stock picking, complex models. In a crash, the conversation suddenly becomes much simpler. Do you have the cash, margin room, or unencumbered collateral to act, or are you frozen? History is brutal on this point. The investors who buy assets at fire sale prices during panics are usually not the ones with the most complex opinions. They are the ones who still have money. The families and funds that emerge owning prime properties, distressed companies, or undervalued shares are often those who accepted boring returns for years in exchange for balance sheet strength. Crash profit patterns are anchored in this fact. Illiquidity converts theoretical wealth into real loss. Liquidity converts other people's forced selling into long-term gains. The market does not reward the clever. It rewards the solvent. Hidden. Fact 4. Forced sellers create the real bargains, and they are predictable prices. During a crash, do not fall evenly or randomly. They collapse first and hardest where forced sellers are concentrated. Leveraged funds, overextended speculators, institutions facing redemptions, households with margin loans, companies that depended on cheap refinancing. You see the same pattern in cycle after cycle. The assets people bought with borrowed money because rates will stay low become the assets. They must unload at any price when credit tightens. The sector that attracted the most aggressive, hot money on the way up becomes the dumping ground on the way down. Those who profit from crashes study not just what is overpriced, but who owns it and how they funded it. They are less interested in predicting the precise day of the downturn and more interested in identifying where margin calls, covenants, and liquidity demands will hit first. Crashes are violent, but their pressure points are not random. Hidden fact 5. Most safe havens are only safe until everyone runs to them before a crash. Investors migrate into assets they believe will protect them. Blue chip stocks, index funds, real estate in prime locations, government bonds, even cash in certain banks or currencies. For a while this works. Prices are supported by the inflows, and comfort returns. Then the system is stressed enough that safety itself becomes a trade. Funds that promise daily liquidity but hold less liquid assets face redemptions. Investors who piled into the same defensive names discover that when everyone squeezes through the same narrow exit, volatility does not care about past quality. Crash profit patterns include this harsh lesson. Nothing is truly safe if you are forced to sell it at the same time as everyone else. The true beneficiaries are those who treat safe havens as part of a broader structure, laddered maturities, multiple custodians, genuine diversification, not as a single magic shield. Hidden fact 6. Leverage turns a price move into a transfer of ownership at the heart of almost every major crash sits leverage, the use of borrowed money to amplify exposure. Leverage feels harmless when prices rise. It simply makes good returns look even better. When prices fall, the math flips. A modest decline becomes a margin call. A deeper decline becomes a wipeout dot in historical crises. You see the same dynamic. Highly leveraged players are forced to surrender their assets to lenders, better capitalized competitors, or vulture buyers at fractions of previous prices. Apartment blocks, office towers, factories, even whole companies change hands not because their buildings or machines vanished, but because their owners could not meet the terms of their debt. The asset does not die in the crash. Ownership rotates. Crash profits are often nothing more mysterious than this: moving into a position where you can be the one buying the asset, not the one surrendering it when the lender calls. Hidden fact 7. Crashes reward those who understand human emotion, not just numbers on paper. Markets are about valuation, cash flows, and interest rates. In reality, crashes are about fear, shame, denial, and desperation. The same graphs that looked like evidence of genius on the way up become evidence of stupidity on the way down. Investors who were celebrated in magazines vanish from view. Risk managers who warned early are mocked, then suddenly discover respect they never had in the boom. The pattern is brutally human. Near the top, people stretch just a bit further because they fear missing out more than they fear losing. In the early stages of the decline, they double down, needing to prove they were right. Only when losses become undeniable do they capitulate, often near the moment when the most prepared capital begins to quietly buy. Those who profit from crashes do not imagine themselves immune to emotion. They design rules, structures, and checklists that keep them from acting on panic impulses at the worst possible time. The discipline is built before the downturn. The benefit appears during it. Hidden fact 8, the black swan, was usually visible in the balance sheets. Commentators often describe crashes as shocks no one could have foreseen. It is a tempting story because it relieves everyone of responsibility. Yet, if you study history, the vulnerabilities were rarely invisible. Unsustainable household debts were visible before housing bubbles burst. Corporate leverage ratios were known before credit markets froze. Concentrated exposures sat in plain sight on regulatory filings. Fragile funding models, such as short-term borrowing against long-term assets, were openly discussed in research reports. What was missing was not data, but willingness to act on it. During good times, pointing at obvious imbalances is socially and professionally expensive. Fees, bonuses, and careers are built around the continuation of the trend. The crash profit pattern here is uncomfortable. Those who protect themselves act on visible risk long before it becomes acceptable to admit that risk exists. Hidden fact 9. Policy rescue packages protect the system, not individual speculators. When crashes become severe enough, governments and central banks step in. They cut rates, buy assets, guarantee deposits, and support key institutions. To the public, this often looks like a bailout of the same people who caused the crisis. In some cases, it is, but the deeper pattern is more impersonal. Policymakers act primarily to prevent collapse of the payment system, not to rescue every investor. They care about keeping banks open, wages paid, and basic credit flowing. If, in the process, some overextended players survive, that is often treated as a necessary side effect. Those who profit from crashes do not count on rescue. They design portfolios under the assumption that any policy support will arrive late, be uneven, and be aimed at the system, not at their specific positions. If interventions help them, that is optional upside, not the core plan. Hidden fact 10. Most people learn the wrong lesson from each crash after every crisis. There is a brief period of humility. Books are written. Inquiries are held. Regulators promise never again. Investors vow to avoid the specific excess that just burned them. For a while, behavior changes. Then memory fades and the next cycle begins. The new bubble almost never forms in the exact same asset class as the last one. That would be too obvious. Instead, leverage and speculation flow into a sector that feels different enough to seem safe. A new technology, a new region, a new instrument. The pattern is tragic. The public learns to avoid the last kind of fire, while a new kind starts in a different corner of the house. Those who genuinely understand crash profit patterns learn something deeper. It is not about housing, tech stocks, or any specific asset. It is about the combination of cheap money, narrative, crowd behavior, and leverage wherever it appears. Hidden fact 11. The biggest winners often look wrong for years. One of the cruelest aspects of preparing for crashes is timing. The people who see the pattern early, who reduce risk, hold more liquid assets, or avoid fashionable bubbles, usually look foolish long before they look wise. They underperform neighbors, benchmarks, or competitors during the late stages of a boom. Clients question them. Boards pressure them. Friends tease them. In extreme cases, they are replaced right before the downturn they were positioned to survive. Crash profit patterns include this psychological toll. To benefit from rare, violent events, you must often accept being early and lonely for uncomfortably long periods. The market punishes not just greed, but also shallow conviction. Only those willing to endure years of looking wrong are in position to be right when it matters. Hidden fact 12. Crashes reveal concentration that diversification should have prevented on paper. Many investors and institutions claim to be diversified. They hold multiple funds, several asset classes, and a long list of line items on a statement. During a real crash, those differences can vanish. Assets that were supposed to hedge each other suddenly move in the same direction as investors dump whatever they can sell. After the fact, you often discover that what looked diversified was actually one big bet on liquidity, on continued growth, or on low interest rates. Corporate treasuries, pension funds, and households discover that they had stacked exposures to the same underlying risks. Those who profit from crashes treat diversification not as having many names on a list, but as deliberately holding things that behave differently when stress hits, different geographies, different funding structures, different counterparties, different time horizons. When the tide goes out, real diversification shows up in what you do not have to sell. Hidden fact 13. The real opportunity window is short, but prepared capital doesn't need long stories. Of fortunes made in crashes often focus on a few spectacular trades. What is less visible is how little time was actually required to lock in long-term advantages once prices finally broke dot in many crises. Assets trade at truly distressed levels for weeks or months, not years. Banks raise capital in a single chaotic quarter. Properties are auctioned in a handful of sales. Bonds change hands in a brief spasm of forced liquidation. Prepared capital does not need the window to stay open forever. It needs to exist at all. Years of patience, caution, and balance sheet strength can be converted into decades of advantage in a short burst of activity. That is the asymmetry at the heart of crash profit patterns. The preparation is long and boring. The deployment is brief and decisive. Hidden fact 14. After the crash, power is more concentrated than before. Every major crisis ends with a system that is, in some ways, safer, and in other ways, more concentrated. Weak institutions fail or are absorbed. Market share shifts toward a smaller number of strong players. New regulations favor those who can afford compliance. Political influence gravitates toward those who help stabilize the system. From the outside, this can look like an injustice. The big get bigger after every fire. From the inside, it is a mechanical result of who had the strength to buy when others had to sell. Crashes are not just about prices. They are about who owns the critical assets, networks, and permissions when the dust settles. Those who understand this do not focus only on the immediate profit from a distressed purchase. They focus on the long shadow, decades of earnings, influence, and optionality that come from owning scarce assets bought in moments of fear. Hidden fact 15. The only reliable crash profit pattern for ordinary people is survival. It is tempting, hearing all this, to imagine yourself as the calm operator who will swoop in during the next crisis and buy everything at the bottom. That fantasy has destroyed more savings than most crashes themselves. The uncomfortable truth is that most individuals are not structurally positioned to be predators in a downturn. They have jobs, families, and limited capital. They cannot wait out multi-year drawdowns without consequence. For ordinary people, The most powerful crash profit pattern is simpler and less exciting. Refuse to be forced. That means keeping critical expenses low enough that you are not selling assets in panic just to pay bills. It means avoiding leverage that can turn a bad market into a personal catastrophe. It means holding a portion of your savings in forms that are genuinely liquid, and under your clear control, crashes will keep happening. They are built into the way human beings handle money, power, and fear. A small minority will always find ways to exploit them. Your primary task is not to join that minority in extracting gains from someone else's loss. It is to ensure that, when the next transfer of wealth happens, you are not standing on the wrong side of the line. The pattern is simple, brutal, and consistent. In every downturn, those who are overextended feed the system. Those who are prepared feed on the opportunities it creates. You do not control the cycle. You do control which group you belong to when the cycle turns.